and welcome to Markets Today. I'm Sonia Shenoy and with me is Surabhi Upadhyay. It was a flat day for the markets. There was a lot of intraday volatility, of course. But by the end, you got a feeling that ahead of expiry, this 8,300 level is just being sort of protected on the downside. We did see a lot of buying, though, in the bank Nifty, and that's what led to a huge surge over there, Surabhi.
Absolutely. It almost felt as if, that hot summer day was really setting in on the last street. There was absolutely no trade going on the benchmarks at least. But, of course, as usual, lots of action beyond those headlines. Let's start with the top stories. Listless day of trade on Dalal Street. Benchmark indices end flat with the Nifty closing up just about 5 points. The Sensex gaining 0.1%. Bank stocks, however, see brisk buying with the bank Nifty gaining over 1%.
And big result reactions today. Tech Mahindra tumbles 14% after a poor show in the fourth quarter. Tata Motors ends 5% lower on disappointing earnings. However, BHEL rallies 5% as brokerages strike an upbeat note on Q4 numbers and prospects of an earnings recovery.
The mid-cap index ends virtually unchanged, but plenty of stock-specific action. Walmart rallies 9% as the US FDA completes inspection of one of its plants. IDBI Bank gains 5% after the management tells CNBC TV 18 that asset quality will improve further in the coming quarters. TTK Prestige, Thermax and United Spirits, however, end lower on disappointing earnings.
All right, those are all the top headlines, and here are the experts that we have lined up for you on the show tonight. Veteran investor Ramesh Damani will tell us why he thinks the bull run in the markets is still not over. Sanjeev Prasad of Kotak Institutional Equities will also join in with his take on the markets. Sudarshan Sukhani, as always, will talk about the technicals, and we'll also get you the managements of some of the companies that declared their numbers today.
All right, so those are the big voices that are lined up. But first, let's start up with the day's trading action. Sharp losses at the open, then some range-bound trade, followed by a bit of a late recovery. That, in essence, was the action on Dalal Street today. Weak earnings continue to play spoil sport as stocks remain on a tight leash. The Nifty finally recouped most of the losses, but the index still ended the day marginally in negative territory. The Sensex, however, managed to gain about 30-odd points. The 28,000 mark, however, is still some distance away for that index. Mid-caps also managed to cling on to some very marginal gains. Anuj is now joining in with a wrap of the day's market action. Anuj, really, banks to the rescue today.
Well, the banks clearly rescued the bulls today because the start looked quite tentative and the market had really bad setup to begin with. Global cues were weak, currency weakened, and of course there was earnings disappointment. But to the credit of bulls, and maybe also because of the fact that it's expiry tomorrow and 8,300 is an extremely important support mark, you did see the late recovery and the market closing flat. The bank Nifty actually closed with 200 points gain. That really was the big talking point, and that more or less negated the impact of earnings disappointment. But let's talk about the stocks which were lower today because of those earnings disappointments. And first, let's start with the large cap ones. Tech Mahindra was the biggest of them, 14% down on that stock. Tata Motors 5% lower, and GAIL, which came out with numbers during market hours, that stock was lower 2%. Not just index stocks, non-index blue chip stocks or blue chip companies also reported fairly weak earnings in today's trade. United Spirits, for example, was down 3.5%, TTK Prestige 4.5%, NIIT down 7%. All of these were earnings reactions. Aside of earnings, the stocks that led the market lower today, Sun Pharma, that was down 2%, Mahindra & Mahindra was down 3%, and Infosys was down 2%. In fact, Infosys has been a big disappointment over the last 2 or 3 days. Metal stocks were also lower today. Stocks like Tata Steel, Vedanta, Hindalco, that was more of a global factor playing out, or a risk-off which was taking place. On the gaining side, BHEL, after its numbers, it was up yesterday, and today it had a nice follow-up. That stock was up 3.5%. ONGC declares numbers tomorrow, expected to be a really good set of numbers from ONGC after a long time. Will be out of the subsidy net, and that's why that stock was up about close to 3%, and Axis Bank was up about 2.5% as well. And finally, in the mid-cap space, the stocks that you need to watch out for, Wockhardt was one of the stocks of the day, up about 10% after CNBC TV 18 exclusive on the US FDA inspection being complete. IDBI Bank was up 6%, and Punj Lloyd was down about 6%. Well, the volatility has been quite high, but tomorrow is the expiry day, so really you'll have to maybe brace yourself for one more volatile day.
All right, Anuj, thanks so much for that. Well, let's bring in our first market voice today. Veteran investor Ramesh Damani says the recent pullback in the market is just a routine correction, and India's bull market is very much intact. Take a look.
It's a classic case in the market of buying on the rumor and selling on the news. So the market started having a bull run almost 2 years back, when it first caught the whiff of a Modi win. So there's been some selling after that. But the good news is that the bull market is still intact, and we're just going through a very painful, probably sideways correction for a few months before it kicks off. The bull market is well and truly underway. There is no signs to suggest that this bull market has topped out. You know, if you see those signs, we'll record them, but right now I don't see any signs. It just suggests there's a painful correction going on. So the correct way to look at this market is to buy a great business at what we think is good valuations. Now, they could be in the construction sector, they could be in the defense sector, they could be in the Make in India sector. I think all these themes will resonate with investors over the next 3-4 years of the Modi government. The government has very clearly spelled out. They'll focus on railways, defense, Make in India, construction. So these are all themes that, you know, warrant investors' attention. And I think they will play out over the next 5 years.
Okay, big voice there on the Indian market. Let's move on then to some specific stock reactions. Tech Mahindra was the one stock that saw very sharp cuts today in trade, falling as much as 14% in a reaction to the Q4 numbers, especially that 500 basis points decline in the margins. Rima Tendulkar now joins in to tell us how brokerages have read the picture. What's the takeaway, Rima?
Well, brokerages have cut their EPS estimates on the stock. So I'll start first with I'll start first with CLSA, where they maintain a sell rating. They've cut the target price by 4% to 550 rupees. They've lowered their EPS estimates by 14 and 6% respectively. They say this is the worst organic dollar revenue growth that we've seen in the last 14 quarters. By that they mean is that if you look at the top line growth, it stands at 6.5% in dollar terms. But that is propped on account of an acquisition. If you strip out the acquisition part of the top line, then your organic dollar revenues have actually degrown by 4.4%, and that's what CLSA means by a very bad performance on the organic dollar front. This is the third margin shock in the last 5 quarters. Their FY15 EPS, the actual FY15 EPS has missed CLSA's expectations by nearly 18%. And even if you hear the conference call, there was very little comfort from the management on the revenue and margins going forward. So CLSA says there is limited near-term visibility on organic growth, and they expect only a sub 12% growth in FY16 in organic constant currency terms. Citi too retains a sell rating, target price lowered to 535. They too have a sell rating. They say that while Q4 is disappointed, there are more headwinds which lie ahead, so they're expecting margins to contract by 100 basis points even in FY16, and slow deal wins in the telecom sector plus industry headwinds will put pressure on growth as well. And they say that despite the 15% correction from recent highs, they remain negative on the stock. There is a Credit Suisse which has cut the target price to 775, but they still retain an outperform rating on the stock because they combat the margin weakness by saying that going ahead there is still ample scope for the margins to improve based on the pyramid structure as well as improvement in utilization, and the company can post decent revenue growth and attractive earnings growth over the next 2 years. But the stock today is reacting to the earnings which are very weak on the revenue front, abysmal on the margin front to come down to 12.7%, as well as the profits which have declined by 40% quarter on quarter. Back to you.
All right, Rima, thanks so much for that. So not a great day for Tech Mahindra at all. Well, speaking of negative result reactions, automated Tata Motors is not out of the woods. That's what it seems like looking at the Q4 numbers. And the stock ended the day 5% lower with really no sign of buyers coming in, even as the day progressed. Sonia, of course, you've been talking about the weak points in the earnings. How's it like? What's the word like now on the street after the Q4 show?
Well, a lot of brokerages believe that there will continue to be shorter-term pain, although in the longer term, the prospects are still positive for the company. So quickly to take you through the brokerage views, Barclays remains an overweight on the stock, although they have reduced their target price on Tata Motors to 685 versus 745 earlier. They say that JLR margins at 17.4% have been a slight miss, and the management on the con call was quite cautious as well. The management indicated that FY16 will be challenging because of a slower ramp-up of the China products as compared to what was expected earlier, and pricing pressure in the Chinese market will also impact the company going ahead. CLSA, though, believes that although it was a weak quarter, there is recovery expected ahead once the management wades through this transition phase. They maintain a buy on the stock. They have a target price of 650, which is still well above the current market price. They say that the JLR margins have been weak, but they will normalize in FY16. Yes, China margins are a concern, and yes, the contribution from the Chinese market is falling, but JLR has very strong buffers and a strong brand value, enough to outgrow the Chinese luxury market. So as I was mentioning, most believe that there could be some more pain in store, but the longer term positives are intact.
Okay, all right. So you have to be patient as far as Tata Motors. That seems to be the word. Let's move on to another story that we've been tracking. It's been doing the rounds for quite some time now. And CNBC TV 18 learns that the country's most successful airline, Indigo, has firmed up its plans of filing the draft red herring prospectus for listing on D Street by July this year. We learned that the airline is looking to offload around 20% stake via the IPO route. Kritika Saxena is joining in with some exclusive details on this one. Kritika, how much is the airline looking to raise, and what are we expecting from Indigo?
Well, it's been about a year and a half that we've been talking about a possible IPO for Indigo, but at the risk of sounding corny, it does look like Indigo's IPO could finally be taking off. Now, in terms of the valuation, the information we've picked up seems quite interesting. The valuation, we understand from sources, is pegged at around $1.6 billion. There have been 5 book runners that have been appointed, investment bankers that have been appointed to overlook at the valuation, the contours of the IPO, and the timing of the IPO. Now, remember, Jet Airways at the point when Etihad had acquired the company was valued at $1.2 billion. So the reason why Indigo's valuation is significantly higher, and the pitch that bankers are making right now, is the fact that Indigo has been profitable compared to its peers. It has been a market leader, again, compared to its peers over the last 2 to 3 years, and the debt figures on Indigo's books are substantially lesser. They have a larger growth base in terms of its domestic and international operations, and that's the reason why they are going ahead with a $1.5 to $1.6 billion valuation. I understand that they are likely to raise around $400 million, and about 25% could be on offer. So they do, of course, hope to bring more liquidity into the company. So a majority of this could be a fresh issue. And I understand that a part sale of stake from Interglobe and KLM Investment, which are the promoter holding companies, it could just be about 5 to 10%, is also likely in the IPO. So yes, hopefully by July 2014 is what we understand that this could finally be taking off.
All right, Indigo's big IPO plans. Thanks so much, Kritika, for that. We'll take a break on that note. But coming up, Sudarshan Sukhani joins in for a technical chat, and we'll also look at some stocks that were in the news today. Stay with us.